This morning we have with us Dr. Adrian Stokes, Vice President, Strategic Planning Projects and Product Development. To my extreme right, Nikeisha Williams, Senior Financial Analyst. The focus today is taming the fiscal beast or saddling more debt. We'll spend most of the discussion today surrounding in terms of the economic development and expectations for 2011. And this is against the backdrop of a very eventful 2010. At the beginning of 2010, what we saw was the implementation of the Jamaica Debt Exchange, which was a game changer for the local economy. That was a prelude to the signing of an IMF agreement outlining significant conditionalities that the government of Jamaica will have to ensure that they implement during the year and for the next 3 years. As I said, today we'll spend some time speaking about the economy and what is expected. I'm going to hand over now to Adrian Stokes to take us through.
All right, thank you, Lissant. I want to start off by setting the backdrop for the presentation, or should I say the international backdrop. I will start off by looking at the U.S. economy. And I think that the story there really is an improving situation. We're seeing where the major indicators are pointing in the right direction. The first variable that we want to look at is personal consumption expenditure. That is 70% of the U.S. economy and pretty much determines where the economy goes. And what we have seen, certainly for the last couple of quarters, we have seen a fair improvement in personal consumption expenditure. And it is telling us, therefore, that the direction is the right one as far as economic growth is concerned. Non-farm payroll or job growth is also doing better. You compare to 2008, where we had the plunge in employment, and what we have started to see over the last year or so, but certainly in the last couple of quarters, we have seen a pickup in job growth, and that's fairly significant. However, given that over 8 million jobs were lost when the recession started in 2008, the pace of job growth, as is still not sufficient to bring down the unemployment rate materially. And so what we're seeing is the unemployment rate still up about 9.7%. And pretty much, even though the U.S. economy is improving, job growth is still slow. And, we expect it will remain anemic for some time. So the summary there, as far as the U.S. economy is concerned, is that an improving situation, but job growth is still slow, and the unemployment rate will remain fairly high, at least for the next couple of years.
Right. In terms of personal consumption, if you can just relate a little bit in terms of the impact of personal consumption as it relates to how that flows through in terms of economic growth, and why the focus has always been in terms of increasing or improving the level of consumption in the economy.
Yes, listen. Well, if you think about what economic activity is made up of, or what an economy is, it's consumption, it's investment, it's government expenditure, it is net exports. So those are the components of aggregate demand. Consumption, right? The consumption component in the U.S. is 70% of that economic activity. So it's telling you that if that component increases or starts to rise, then its impact on overall economic activity, becomes buoyant. And what we have seen is, that expenditure rising, and it is a good sign for the U.S. economy.
Pretty strong in terms of leading economic indicator.
Yes, it is definitely, I would say a leading economic indicator, definitely a coincident indicator, but it is pointing in the right direction. It argues well for the future. As far as, if we go across the pond, right, and we go to Europe and look what's happening there, we're seeing, what I'm calling a tale of two Europes. On the one hand, when you look at when we say Europe, we're talking about the Eurozone, right? The 16, 17 member countries that make up the Euro bloc. Now, what we're seeing is, if you look at the overall picture, it's an improving one, right? We're seeing major indicators pointing in the right direction. We're seeing overall consumer confidence rising following the trough that we saw in 2008, and that certainly is a very good situation. You look at countries like Germany, for example. Their unemployment rate is actually falling, and they are maybe coming up in the next couple of quarters into an inflation problem. We have seen the ECB, banker, the central bank governor, Jean-Claude Trichet, even in recent times talking about the possibility of raising interest rates to curb inflation. So that's the situation in one part of the Eurozone. If we look in what we call the peripheral countries, places like Portugal, Ireland, Italy, Greece and Spain, we're seeing a different situation. And the theme or the main thing that's coming out from these countries is rising debt levels. Rising debt levels that's causing the finance officials in those countries to start to pull back fiscal expenditure to try and curb the fiscal deficit and hopefully pay down the debt over time. So pretty much what we're seeing is in one section of the zone, Germany, right, in particular, we're seeing rising consumption, we're seeing falling unemployment. It's certainly a good situation. But in other places, Ireland, Greece in particular, we're seeing where debt levels are rising and the market is becoming a little bit jittery about these countries. And so overall, the picture is a mixed one.
Just in terms of, what would you say in your mind really account for the difference? Is it the fundamental structure of the economy prior to the Eurozone implementation that really is just now some persons are saying is really coming home to roost because some of these economies fundamentally wasn't as structured as the more developed countries within the Eurozone? Absolutely, that's a very good question, Lissant.
Now, if you look at a country, an economy like Germany, very advanced, highly productive, right? Significant use of technology. And, if you look at other countries, for example, Greece, right, they've always had fiscal problems. They've always had debt problems. And unfortunately, the Eurozone or the Euro masked some of those problems. Sure. And what we saw in 2008 when the financial crisis broke and things started to unravel, we saw, and pretty much the tide went out. We saw countries like Greece, Ireland, Spain to a lesser extent. We saw problems, underlying structural problems in the economy. Greece in particular ran, they were just very bad at managing their fiscal side. Ireland is an interesting case because leading up to the crisis, they were actually running fiscal surplus, right? They were actually doing
poster child.
Yes, right. They had what they call it the Celtic Tigers, right? So they were really doing well, had really good growth, really good development. But the problem they got into was that they had a property boom, a significant property boom, where funded primarily from funds coming out of Germany and the other bigger economies in Europe. And it caused their economy, to become uncompetitive. And when the crisis broke and the funding choked off, we saw where the banks got into problems, and the government, the Irish government, have had to bail out the banks, and that's causing the debt level to rise significantly, and hence causing the significant compression in the Irish economy. So that's kind of the international backdrop for the presentation today. I'm going to move now to Nikeisha, who will take us through the local situation.